Gas crossed $4 a gallon on Tuesday for the first time since 2022, and the Federal Reserve cannot cut rates to stop it. That is not a contradiction. It is the central tension defining markets right now. The U.S.-Israel campaign against Iran has effectively closed the Strait of Hormuz for 5 weeks. Roughly one-fifth of the world's oil supply passes through that 21-mile choke point. WTI crude, which was trading near $65 a barrel in late February, has surged past $100. Higher oil feeds directly into transportation, food, and manufacturing costs, and those do not respond to rate cuts. Fed Governor Schmid warned Tuesday that inflation could get stuck near 3%, well above the 2% target, even before the energy shock fully passes through. Markets rallied hard on headlines that Trump signaled openness to ending the war without retaking the strait. The Dow surged over 950 points. But analysts at Signum Global and Wolfe Research immediately pushed back, calling a full withdrawal extremely unlikely. The reason is structural. Leaving Iran in control of the strait would let Tehran charge passage fees on one-fifth of global oil flow indefinitely. The rally, in other words, priced in a resolution that most close observers think cannot happen the way Trump described it. What remains is the harder question. If the war drags into May and oil holds above $100, the Fed faces a choice it has not confronted since the 1970s: let inflation run or tighten into a slowdown. That same energy pressure is reshaping the AI infrastructure race, but through a different mechanism. On Tuesday, Nvidia announced a $2 billion strategic investment in Marvell technology, not a capital injection, but a deepening of the NVLink fusion partnership that allows third-party custom chips to plug directly into Nvidia's interconnect fabric. Marvell's stock jumped 12%. The deal matters because it establishes a principle. Nvidia is willing to co-invest in the ecosystem around its architecture rather than compete with it. That reduces the risk for hyperscalers designing custom silicon, because their chips can now interoperate with Nvidia hardware rather than replace it. The same day, CoreWeave secured an $8.5 billion GPU-backed loan, the first such facility to achieve investment-grade ratings from Moody's, with Nvidia GPUs as collateral. CoreWeave's total financing commitments over the past year now stand at $28 billion, against a planned 2026 capital expenditure of $30 to $35 billion. Meanwhile, Oracle announced it would cut thousands of jobs while simultaneously ramping AI data center spending, the same pattern of redirecting human capital costs towards compute infrastructure that has defined enterprise tech since early 2025. The direction across all three moves is the same. The AI infrastructure cycle is not slowing. It is consolidating around fewer, larger players who have secured capital at scale. The risk is not that spending stops. It is that energy costs from the Iran war hit data center operating budgets before the revenue from AI services catches up.
Two shocks are now running in parallel, and they are starting to interact. The JOLTS report released Tuesday showed February hiring fell to a 3.1% rate, the lowest since April 2020, when the economy was physically shut. Job openings dropped to 6.9 million. Layoffs stayed pinned near historic lows, and quits barely moved. Economists described it as a locked-out market. No one is being fired, but almost no one is being hired either. Chief economist Heather Long at Navy Federal put it plainly: a 3.1% hiring rate in an open economy is the kind of number that used to require a forced closure to produce. Before the Iran war, that dynamic was manageable. Oil above $100 changes the arithmetic. Labor economist Nicole Bashad warned that surging gas prices would hit transportation, manufacturing, and retail simultaneously, pulling March hiring even lower. The April jobs report, due in May, is the number that will determine whether this freeze becomes a contraction. The weight of evidence points toward a stagflation setup: inflation running above target, hiring collapsing without a corresponding rise in layoffs, and an energy shock of uncertain duration. That setup only resolves in one of two ways. The Iran war ends quickly and oil retreats below $80, allowing the Fed to hold or cut. Or the war drags into summer, oil stays elevated, and the frozen labor market tips into active job losses. The verification benchmark is Friday's March payrolls report. If non-farm payrolls come in below 100,000, the second scenario becomes the base case. If they hold above 150,000, the freeze is still contained. The one fact that would prove the bullish read wrong: any news that the Strait of Hormuz reopens before mid-April. That single event would unlock the entire dovish sequence: oil down, inflation expectations down, and a Fed with room to move.